Well, of course, as we've been telling you since 10 o'clock yesterday morning, in the final rate hike decision of 2022, the Bank of Canada raised its key benchmark by 50 basis points. That's 7 consecutive hikes this year. But perhaps key here, Bank of Canada Governor Tiff Macklem is starting to suggest that further hikes are not looming on the horizon. Let's keep our fingers crossed. But joining us now for a look at how these moves can impact your mortgages, we're joined by John Shmuel, Director of Content Strategy and PR at Rates.ca. John, great to have you in here the day after the Bank of Canada's last rate hike of the year. But the question is, do you think this is potentially the last rate hike we will see for a little while, perhaps, from the Bank of Canada?
Yeah, that's a big question, Nick. So I feel like we're close, right? I don't want to jinx it, but we might see one more in the new year.
Yeah.
But there are signs right now that what the Bank of Canada has been doing is taking effect, right? We saw the housing market basically freeze starting in spring, summer when the rate hikes began.
Yeah.
And we've seen that continue. Sales are at multi-year lows. We're not seeing the job market or inflation come down too much and be impacted too much by the rate hikes, but those are lagging indicators. So we expect that within 12 months of rate hikes beginning, that those are going to start to feel the effect as well. So I think the Bank of Canada, especially after the meeting yesterday, signaled, listen, we're going to look at that data, we're going to see how it plays out, and we're going to make our decision based on that.
Right. Let's talk about the decisions some people are maybe making around their breakfast table this morning when they're taking a look at mortgage and mortgage rates. And if you're writing a variable rate mortgage right now, I mean, I've heard anecdotally stories of people paying maybe $1,000, $1,200 more per month than they were perhaps just 2 or 3 months ago. I mean, I don't know where these people are finding extra money, but this is significant. What does that mean to people with variable rate mortgages right now? Do you have any advice for them, or how do they sort of tame the beast, as it were, if they even can?
Yeah, definitely. So it's been a painful year for anyone that's had variable rate mortgages. I think the main thing you have to do is look at your cash flow every month, right? Are you at risk if the Bank of Canada went another 50 basis point, another full percentage point higher? Would you not be able to pay the bills, right? If you're in that situation, you need to start looking at locking into fixed rate mortgage so that your costs don't go any higher. And the good news is we've seen bond yields come down and fixed rate mortgages follow bond yields.
Yeah.
And some lenders are starting to offer discounts on fixed rate mortgages. So we're seeing some below 5 percentage point offers, which we haven't seen in a while, right? So for anyone with the variable rate mortgage, that's an opportunity right now to say, hey, is it time for me to lock in? That being said, you know, we might be near the end, right? The most pain, that big hike we saw, the full percentage point in July, right? We haven't seen that in a while. The Bank of Canada saying, hey, we're gonna look at this and we're gonna see what we're gonna do. They're not signaling, hey, we need to really do some big hikes here to get inflation under control.
And that's the thing, isn't it, is the asterisks that you have to put and sort of timestamps on these conversations of we might be. It seems like we're kind of at the end, because there's almost this Vegas gamble, like if you're thinking about locking in right now, are you going to potentially lock in almost at the highest rates, and then in a month or 2 months or 3 months, maybe there's, oh my goodness, there's a full percentage point down. I could have done better. I could ride this out for a little while. That's a tough gamble here, isn't it, to sort of square that circle and figure out the lock in now. But you could lock into perhaps a 1 year as opposed to a 5 year or a 10 year, right? And those kind of products, is that what you would advise? Like maybe look at a 1 right now versus a 3 or a 5? Is that kind of where the market's at? Or?
Yeah, I would say 1, 2, 3s are very popular right now for that reason, right? If you're thinking that interest rates are going to be lower soon, we're near the end of this hiking cycle, you probably don't want to lock yourself into a 5 year, right? You're just going to be kicking yourself after that happens.
Yeah.
At the same time, you know, if you look at 1 and 2 year fixed rate mortgages right now, the interest rates there are considerably higher than the 5 year. And that's just a function of the bond market, right? Bond yields are inverted right now. That's signaling a recession. So I would say you're essentially taking a much higher rate than you would over the 5 year fix for essentially the same variability as a variable mortgage, right? People might think 1 year is safe. At the same time, you just have that rate for 1 year, right? 12 months can go by quite quickly. And in 12 months, if we're not done this inflation battle, you're back at stage 1 of being exposed to fluctuating interest rates. So that's the only thing I would caution there when looking at 1 year versus 5.
It's a good word of advice indeed. Well, the 12 months can fly by quickly, and so can an interview on television. John Shmuel, thanks so much for joining us from Rates.ca. Really appreciate the time and insight today. Thank you.
Thanks for having me.